Hello and welcome to ETF Pulse, ETF.com's vodcast. I'm your host, Kristin Myers, editor-in-chief of ETF.com. Here as always with my co-host, Nate Geraci, president of the ETF store. Let's take a quick look at the Pulse rundown. So first up, we are going to be talking about the record pace of ETF flows. It's a topic that we've touched on before, but we have $437 billion flowing into ETFs so far this year. We'll be chatting that. And it looks like ETF share class approval is forthcoming. We're going to be talking about the implications for investors, particularly around taxes. And Trump driving the markets yet again. Surprise, surprise, Nate. This time it is around nuclear energy, although we do have a tariff update that we will also be sharing with you guys. So we'll be chatting some nuclear energy ETFs. And for our crypto topic of the week, this is not official, but we've just decided to make it unofficially official. Talk crypto every single week. We're going to be talking about the newest XRP ETF that launched last week, volatility in XRP. So Nate, how are you? I just came back from vacation. How was your holiday weekend?
It was nice. It was relaxing, but it rained here all weekend. So it sounds like you had much better weather.
I
got
did.
to enjoy the sun a little bit.
I did. The Cayman Islands, or Cayman Islands, as I'm told it's pronounced, actually, had beautiful, beautiful weather. And I came back to do, I really came back for this podcast, honestly, Nate. I would have stayed forever.
And now you get to talk record pace of ETF flows. Actually, I really like our lineup of topics this week. And I do like that you've worked in a crypto topic. I know we've talked about this before, but I think I have you now. This is like a weekly staple.
I've come to the dark side. You had cookies and also tequila, although I'm drinking less tequila lately. But I'm here to stay, apparently, and I'm okay with it. But we're going to get to the crypto stuff. You're right. Actually, we do have a lot of good stuff to chat about in today's episode. So first up, we have flows. So we've kind of touched on flows so many different times just because we keep coming back to the fact that it seems as if every quarter, every year is just so indicative of how much interest and I don't know if we want to call it a passion, but excitement and enthusiasm really clearly exists inside of the ETF space. I mean, $437 billion of inflows into ETFs so far this year. If we keep up this pace, and we haven't even hit the quarter yet, where we're anticipating inflows to really start to accelerate, that's going to be coming up in the next couple of months. I mean, we're going to have another record-breaking year. And for everyone that doesn't remember, 2024, we had $1.1 trillion of inflows. So we are set to break that record yet again. I'm actually curious, what do you think is driving this kind of fervor? I mean, this is happening, again, as backdrop, despite COVID, despite geopolitical kind of roller coaster rides and ups and downs. We've had this despite, let's just look at 2025, recession fears, inflation fears, the trade war kind of back and forth that we have. Investors are still continuing to pile money into not just the markets, but specifically ETFs. Why do you think that is?
Yeah, it's remarkable because despite all of those things that you walk through, clearly 2022 was a difficult year for the markets. Markets bounced back quickly after COVID, but you look over the last 2 years and the S&P 500 each year was up, 20 to 25%. And so it made perfect sense to have investors piling into equity ETFs in particular. But what I think this year is showing is that, and I know this is a little cliche, but ETFs have clearly become the go-to vehicle for pretty much every type of asset class, right? ETFs don't need the stock market ripping higher to drive inflows anymore because investors are going to express whatever view they have by using ETFs, whether that's a view on international stocks or the bond market, crypto now, whatever view an investor wants to express, they can do that now. And I don't think that that's necessarily new. And what I'm saying here isn't profound, but it's just clear now that ETFs are the vehicle of choice for all types of investors. And I do think we hit a tipping point a couple of years back where that became the case. It became the case. We can look back at the growth of ETFs going back the past 2 decades, and you clearly see the direction of travel. But there's been this acceleration, and I don't think we're going back. I think that no matter what the market environment looks like, this is going to be the standard moving forward. So investors are using ETFs.
What do you think, if we had to make, which is the chicken and which is the egg? So do you think we are seeing this interest because of all the different types of ETFs that exist out there. And as you were kind of talking about, there's just so many different products. If you want to trade, there's a lot of ETFs for that. We're going to be chatting about it a little bit later on in the show, at least when it comes to that XRP ETF. A lot of volatility that exists. If you like crypto, there's an ETF for it. If you want fixed income, there's an ETF for it. Or do you think the products are following the interest? Like, which do you think really comes first almost?
It's a great question. And I've said for a long time that I actually believe the influx of ETF supply is what is driving demand. Yeah. Because investors, to what I was saying, they can express whatever view they want much more easily now. And we've talked about the rise of active ETFs. That's a very easy one to point to. There's a much greater supply of the top active managers now in an ETF wrapper. I think that's driving some demand. Crypto is an easy one to point to as well. We know the flows into that space, but it's really any asset class. If an investor wants to make a call, they can do that, very easily. The other thing that I think is happening here, and this is at a much more basic level, is investors, when the market goes down now, like we saw in April, I just think investors are much more disciplined overall, especially retail investors, right?
I was going to say that. I think there's something to be said about I don't know if I want to use the word education, but I'll just say that anyway. I think there is something to be said about the amount of information and education that has been made available to retail investors that has kind of gone hand in hand with the uptick that we saw of retail investors entering the market, particularly in COVID. That ETFs just became the natural kind of like first place and first step, and that we're now just seeing more and more interest and education and to your point, discipline around this as an investment vehicle or around investing in general.
No, I think that's 100% happening. And what's sort of funny about that is if you go back to the COVID timeframe, when we know a lot of retail investors got involved in the markets, everybody was sitting around, they had some extra money to put to work. Fast forward a couple of years, market went up, but then 2022, as I was saying before, was a really difficult market, and especially in the high flying areas, whether that be crypto, or I think about an ETF like the ARK Innovation ETF. And what I think happened there was that a lot of retail investors got burnt pretty significantly. I think it was really difficult, and they learned a few lessons. Yeah. And so now you go into 2023, 2024, 2025, when we've had these, brief dips or there's some turbulence in the market, I think they look back on that and go, you know what, I'm not falling for that again. And I'm going to stay the course or double down and buy the dip. I'm not saying everybody has that mentality, but I definitely think that many more investors, especially retail investors, have that mentality now.
Yeah, there was a bit of, for particularly millennial investors, like we only knew the markets going in one direction for the most part. And then I think that we've now just become kind of like older, savvier, wiser investors now that we've learned exactly what the market can do to the downside. Because there was a time where it felt like you could throw your money on anything and it was going to go up regardless.
Well, I was reading, there was a Wall Street Journal article, it was over the weekend, and they had a quote from Vanguard's president, Greg Davis. And basically what he said is, if you go back to the market turbulence in early April, Vanguard saw a 5-to-1 buy to sell ratio from their clients. Now, Vanguard investors in general are a different breed, right? I think we would both agree to that. But I think that shows the mentality now. I mean, that's a great data point. And, I wonder what changes that. Like, is it going to take a 40% down move, a 50% down move? Will everybody just always buy the dip no matter what, no matter how far the market's down?
And that's what you see in a lot of headlines. Is now the time to buy the dip? Is now the time to buy the dip? Buy the dip. Like, I mean, they're happy if you bought in April. You're not upset in May. I'll tell you that. Like, it's a strategy that works. I mean, obviously, then you move on from trying to time the market to just making sure that you have time in the market. That's the next natural progression in that kind of investing sort of strategy or pathway. But it's funny.
All of this helps ETFs though, right? I mean, going back to the original point on record flows, people who are putting money to work, are they picking an ETF or a mutual fund? I think we both know in general, they're picking an ETF. If you're launching a new product, are you launching a mutual fund or are you launching an ETF? And that's where I was going back to. This isn't going to change. I know this is nothing really, again, new, but it is remarkable to see, because I've been in this industry for a long time, and I think everybody was sort of waiting to that. We got to the point of this like escape or exit velocity, and that's what we're seeing now.
Well, it's actually, we made the rundown, right? But we're so brilliant. Sometimes they just happen. These things dovetail quite naturally on each other because we want to talk ETF share class, which I think is going to stimulate, right, this sort of interest and the inflows into the ETF market even further. So let's talk about that, because the SEC essentially has this kind of approval, and it looks like it is pretty imminent that we will see the sort of barrier, particularly between those mutual funds and ETFs, like those walls really start to kind of come down because of the ETF share class. Now, I've seen I've seen excitement for it, but then of course there is also some of the potential downsides, and I haven't really gotten, I don't think that they have, I don't even think the SEC or really some of these like companies have really gotten their heads around exactly how the tax implications are going to go, since certain events obviously trigger tax events for mutual fund holders or mutual fund participants that do not on the ETF side. Now, if those barriers come down, do we start to see increased tax implications for ETF investors? So I think obviously the ETF share class is going to make it a lot easier than instead of a full mutual fund conversion, which we also are already seeing a lot of, because as to your point, I don't hear anyone saying that they're launching a bunch of new mutual funds. I mean, that just seems like a dead strategy. It's all about ETFs right now, and that's where all investor dollars are going. But the mutual fund market and industry, however, is still huge, and there is still a lot of money in mutual funds. And for anyone listening, if you're like, I don't invest in mutual funds, if you have a 401k, yes, you do. You absolutely are invested in a mutual fund. And so this ETF share class is going to impact you, even if you don't buy mutual funds inside of your regular investment portfolio. And I don't know too many people that do actually either. So what are your thoughts in terms of this share class and thoughts around some of these tax implications? Are you looking at this as a net positive, or are you still kind of like, we still need more details?
Yeah, I mean, there's a lot there that you laid out. I think, first of all, yeah, everything that I'm hearing is this is fairly eminent with the SEC, that we're expecting them to approve this. And so I think it's important to cover just because investors are going to be hearing a lot more about this. I actually think this could be the ETF story of the year. And the reason why is because we are going to see literally hundreds, if not thousands, of new ETFs launch as a result of this. Last I saw, Kristin, there was something like 50 plus asset managers that had filed for this structure. And it's many of the biggest names out there. I mean, we're talking BlackRock and Fidelity, Dimensional, it's the biggest players out there. So, that's a huge deal. I think, let me go through a couple things here. I think number one, going back to what we were saying, I think the great thing for investors is there will obviously be a lot more choice on the market. And a lot of these strategies that only exist in a mutual fund wrapper will now be made accessible in ETFs. Right. Now, that's a double-edged sword too, right? Because it makes due diligence much more cumbersome. I mean, there's already a lot of ETFs for investors and advisors to wade through out there. Now add another, several hundred or several thousand potentially, and that makes it much more difficult. And the other, piece of that is if you think about all the mutual funds that are out there, like how many variations of a large cap mutual or a large cap strategy can you have? Right. So trying to figure out the distinction between these, I just think there's a lot that investors will have on their plate. In terms of the tax efficiency or the tax implications, I mean, at a very basic level, the big thing here is that the mutual fund will be able to wash out capital gains through the ETF structure. And that theoretically should improve the tax efficiency of the mutual fund share class, because the ETF's already very, tax efficient. There's also potentially some like operational efficiencies to be had, or trading costs and those sorts of things will be lessened. And the other factor here too is the performance track record carries over. So when I going back to talking about due diligence, if say a mutual fund's been out there for 20 years and there's now an ETF share class, investors can easily look back on that performance track record and see that. Now, the potential downside is that, let's say there are significant outflows from the mutual fund share class to where they have to sell positions and the ETF can't wash all of those, through. Right. That could be a negative for ETF investors, where they actually get hit with a tax bill. Yeah, and it's possible,
right? Because it's going off the ETF investors back, right? Some of these tax efficient.
I think that would take a fairly rare situation. I mean, there'd have to be significant outflows from the mutual fund share class. It'd have to be in fairly short order. I'm not saying it can't happen. It's definitely something the SEC has been focused on. They call it cross-subsidization, to where they don't want one share class sort of carrying the weight for another in terms of taxes or costs. And so that's really what's taken this so long to be approved by the SEC. But overall, I view this as a positive for investors. Again, there's going to be more choice out there. The other interesting thing here too is there are several issuers who are ETF specific issuers that have filed for a mutual fund share class. In other words, they're trying to go the other direction. And you may go, well, why are they doing that?
Right.
It goes back to what you were saying with 401k plans, and that we know mutual funds dominate 401ks. And so let me state it like this. If you're a mutual fund, primarily a mutual fund issuer, the vast majority of your assets are in retirement plans, right? That mutual funds, we talked about that, I think, last week. Mutual funds dominate the retirement plan landscape. But if you're an ETF issuer and you have all these wonderful strategies, and let's say you don't have mutual funds, you're missing access to that entire pool of money on the retirement plan side.
Billions of dollars.
Right. So what better way to solve that than launching a mutual fund share class? And that's what they're trying to do. So this is going both ways. But in both cases, this is asset managers wanting to have their cake and eat it too, right? They want to have that lucrative 401k business, but also be able to pursue the much higher growth ETF market. So this is going to be a big story. It's interesting to watch. I think the big takeaway, there's going to be a lot more choice for ETF investors. That means you're going to have to do much more homework and figure out the distinction or the differentiation between these strategies. And I'm not that worried about
more
the cross
choice and also more competition. I mean,
more competition for sure.
Because we're going to know that for some of these mutual funds that exist, there's already an ETF for it, for the most part. Like you don't have to go to the mutual fund, right? If you are someone that already owns an S&P 500 ETF, you don't need to go to this sort of broad market.
And and I think we're saying the same thing. I mean, that's where I get into like how many variations of a particular strategy do you need? And at some point there is oversaturation. We may, I'm not going to say we're oversaturated now, but I don't know that we're that far away from that. I mean, there's already, however you want to slice and dice the market.
In certain areas, I think we definitely are approaching an oversaturation. And I kind of think about it in the streaming, bear with me, like the streaming business space, right? Like at first it was exciting. There was a rush to it. And then almost every single platform had a streaming service. And then it got to the point where it was like, this is too much. And then
there's like too many shows out. How do you pick which one to watch? They all kind of look the same. Some variation of Yellowstone or whatever.
Right. You start seeing consolidation and you start seeing some of them just start falling off. And so that's the way the rubber band always goes. But I mean, no, it's definitely exciting. I will say as my final note is still a plug for opening up 401ks and all retirement accounts to more investor choice. I don't think everyone should have to be forced into mutual funds that they don't like or understand. But that's just my general plug that I always have to say every time we talk about retirement.
And real quick, before we move on, I'll just say to that, I agree with you. I actually think this ETF share class structure is a next step down that path because ETF investors or investors in general will be able to access pretty much any strategy in an ETF wrapper. And so at some point, they go to their 401k plan sponsors and go, why don't we have ETFs in here?
Yeah.
Like in other words, I know it sounds really basic, but if you're an investor and all you know is ETFs and that's what you're comfortable with, at some point you're going to demand those in your retirement plan. It'll just be a natural evolution. It may take a while, but I do think we'll get there.
Yeah, that's good. That's I don't know about the final frontier, but it's a frontier that's out there.
The Alamo.
Yeah.
The
all right. Well, let's talk Trump. So two things. First up, we're not going to necessarily chat this too much. I'm tired of hearing you say that you're absolutely correct. Look at you beaming already. So annoying. Trump has delayed tariffs on the EU until July 9th. We're seeing markets pop this week. Europe ETFs are doing well. We've got VX US. That is a total international ETF or fund that exists from Vanguard. Then we have VKD. That is the FTSE Europe ETF, absolutely popping on this news. Nate Stradamus strikes again, can investor on tariffs. But I felt like we had to mention it just because we are talking about Trump moves and how it's driving the market. So
yeah, I don't have anything new to add here. I can take a second victory lap if you'd like. I'm happy to do it.
Nothing new to add. We just have to do our due diligence and let the people know what's happening. But yes, we have a tariff delay. I'm sure at some point in the next couple of weeks, around July, if some sort of deal comes together, we'll probably mention it, and then we'll let Nate take another victory lap. But okay, so we did have, however, an executive order from Trump, who is trying to stimulate the nuclear energy industry. Now, this is particularly important, especially if you are someone who invests in tech and invests in AI, because they all need a massive ton of power. Coal just isn't cutting it. And you need nuclear energy. And we are now seeing nuclear ETFs absolutely popping. And of course, I have to mention Nukes, NUKZ, that's the Range Nuclear Renaissance Index ETF. It was an ETF.com award winner. It was actually nominated up and down the ETF.com awards. It did not win ETF of the year. That, of course, went to VU, but it did, and it also didn't take home new ETF of the year. That actually went to IBIT. However, it did take home several awards this year, and it's absolutely, it did incredibly well last year. But so far this year, in the 1 year, it's up about 39% over the past year, up about 25%, or just over, rather, I should say 24% so far over the past month. Year to date, a little laggy, up 14%, but that's really saying something, up 14% when you compare it to the broad market. Just it far beats the broader market, at least year to date. But yeah, I mean, we're seeing these the nuclear energy ETFs, which have been kind of battered lately, thanks to geopolitics, and spot uranium prices have really fallen. I think it was like 30%, a massive turnaround.
Yeah, I mean, a couple of things here. First of all, and this is, I always say this, politics aside, I continue to be astounded at just like the number of executive orders and just how fast this administration is moving. And we can talk about whether what they're doing is good or bad. I'm just saying the amount of initiatives they have is just mind-boggling. And I think that, I am certainly no nuclear energy expert. And I think, I'm always hesitant to try and make investment plays around this type of stuff. But I just bring up all these executive orders and everything going on because I do think it's interesting to watch. And what you're going to see, and I think this is going to be the case throughout the Trump administration, you're going to see these pockets of the market occasionally jump up, have significant outperformance based on the headlines of the day. Maybe they fall to the back, the wayside a little bit, and some other area pops up. I think it's interesting to track. And, to your point, Trump signed, I think it was several executive orders last week. The goal, it sounds like, is they want to quadruple the country's production of nuclear power over the next 25 years or something like that. And a big part of the way that they're attempting to do this is just by lessening the regulatory burden around this entire industry. So lessening the regulatory burden around things like uranium mining and enrichment and all the way to nuclear reactors. And I think you hit the nail on the head. I think
I laugh though when you say that, less, because isn't that what we all want? Less regulation around it.
But that's what they can. Again, we can debate the merits of that and whether it's good or bad. But that's sort of how they've positioned a lot of their policies is lessening the government involvement. But I think you hit the nail on the head in that a big reason why they're doing this is because of actually artificial intelligence, and that these data centers needed for AI, they require a massive amount of energy. And I think the Trump administration is on record as saying they want the US to be a leader in artificial intelligence. And so energy plays a role in that. Nuclear can certainly help meet the energy needs of these data center. I also think there are some I think there's some national security implications here as well, or defense angles, just as it pertains to nuclear power. But the bottom line is they want nuclear energy to be a much bigger part of the energy supply. I think right now it's something like 20% of the U.S.'s overall, energy supply or source, or it means like 20% of the country's energy.
Which I think is actually a surprisingly large number that I think most people
I think so too. Yeah, and obviously it's viewed as being much cleaner than, to what you were saying, coal or fossil fuels.
Yeah, I think it's carbon neutral. So here's the thing about nuclear that I find really fascinating, because I love energy. When I started reporting, I started out doing energy. Nuclear is the one energy type that I feel like we have continuously talked about as the next wave, and that wave has never crested. It has yet to crest, because we've had so many incidents when it comes to nuclear, like Chernobyl, for example. It has really kind of, I think, dampened enthusiasm and interest in nuclear energy.
It's a perception. Again, I'm no nuclear energy expert, but I think it's just the perception of those things. Because if you look at actually how many, the times that there has been a significant event, it's been really bad.
Yeah.
But there haven't been that many of those.
I mean, there's just been, you hear about nuclear, whenever you hear about nuclear, it's always because something has gone horribly wrong with nuclear, right? Right. If you and I were to go out onto the street and we were to say to people, hey, do you want like carbon neutral, clean energy, blah, 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 people would say yes. And then if you said, hey, would you like them to build a nuclear power plant, 15 minutes from you? I think most people would probably say absolutely not, because they're afraid of it. And so
I agree.
I don't give investment advice, but it is, when I think about energy, it almost feels like you're not late to the nuclear party if you're listening to this, like, because it hasn't happened yet with nuclear, I don't think. And I don't.
That's why there's also debate around here. Like when I mentioned the Trump administration, one of their goals being to lessen the regulatory burden, I saw you sort of roll your eyes, which is, I think, a natural response because of what you're saying, in that if there are already perception issues around the safety of nuclear, and now you're lessening, the regulatory burden, what does that mean? But I also think that, we have to decide, when I say we as a society, where our priorities are. So do we have concerns over pollution and fossil fuels? And if that's the case, are there other alternative sources of energy that are cleaner, with nuclear being one of those? Can nuclear meet the energy needs? Or, you can start getting into solar and wind and what it takes for those sources to be able to produce the energy needs that we need. They can't get there. So we have to decide, is it sort of the lesser of the evils out there, that we want to pursue energy wise? But from an ETF perspective, I love that you brought up nukes, because I was looking at the performance of that. I think if you go back to the beginning of 2024, it's up about 100%. And so that is going to get people's attention. We still haven't seen real flows into that product, but at some point you can't ignore that.
I was looking at the fund flows so far this year. Let me just quickly go back onto that tab. Year to date, fund flows are just over 105 million.
Which, for that type of performance, I would have expected much more significant flows. And Nukes has had some headlines, as you mentioned, ETF.com. There's some nice pub around the awards with that. But if you look across the entire space, you have the VanEck uranium and nuclear ETF, ticker NLR. There's the Themes uranium and nuclear ETF, ticker URAN. You can go to more specific uranium ETFs, like the Global X uranium ETF, URA. I think that's the biggest out there. Sprott has a uranium miners ETF, ticker URNM. So I just think the space, it will be interesting to watch.
Which I also think Sprott uranium was also a ETF.com award.
I think you're right.
It wasn't a winner, but it was a nominee. So I actually pulled those two up. Let's just really take a really quick look, at least when it comes to the performance, because as you're right, fund flows we've not seen flows following performance in this space. So URA, that's the Global X Uranium ETF. It is up in the green. I'm taking a look at the performance right now. Over the past, for the last 5 years, you're up over 26%. For the last month, you're up about 26%. Now, when you're looking at the 1 year, that's when you do see a little bit of a decline. You're down over 12%. Then you've got URNM, as we've mentioned, that was the Sprott Uranium Miners ETF. 1 month, we're up about 21%. And when you look at the 3 year, you're only up about 7%. 1 year, you're actually down over 35%. So there is a little bit of like volatility and a clear divergence here, because Nukes does not have some of these performance to the downside that we're seeing with URA and URNM.
It's a good reminder. If you want to play a theme, you better look under the hood of your ETF, because these they hold different things. They approach this particular theme from way different angles.
Yeah, I'm looking at the holdings right now. I mean, one of the top holdings under Nukes is Rolls-Royce. That is not true for URNM. They all have Cameco Corporation. Again, they do have some of these. You're going to see some of these things that are the same, but you're absolutely right. That is when you got to start kind of looking under the hood, because you think, well, URNM is not doing well, then Nukes shouldn't be doing well either. But again, very different approaches to the theme. So I mean, nuclear is interesting. I love all things energy because it wraps in so many different topics that I love. And I love nuclear. I actually do. I actually love the nuclear story because there's just so much that happens inside of nuclear. It's like the next wave.
if you remember, in 5 years from now, nuclear is going to be powering this podcast because it's going to provide the energy to the data centers. And remember, it's going to be AI versions of you and I. We're going to be on the beach together.
You're totally right. A robot Nate and a robot Kristin are going to be doing this podcast powered by uranium and probably doing an ad at some point for nuclear energy. We're as grunts, you and I will be working. Unless our AI versions of us actually give us the money and the proceeds, because what do they need it for? They don't have to eat.
True.
We'll see. All right. Last up, crypto topic of the week. I wish we had like a banner or something like that. New XRP ETF has launched. Volatility Shares introduced the one times XRP ETF. We actually have two of them. So there's tickers XRPI and XRPT. One is a 1X, one is a 2X XRP ETF. We're just getting, it feels like every other day I'm seeing something new about the Ripple ETFs, and yet not the spot XRP ETF. We are doing every other kind of XRP ETF that we possibly can without doing an XRP ETF, which is so weird to me. Doesn't that feel a little unusual to you?
I feel like you're just trying to bait me. I mean, that's how you're going to get me going, because I talked about this ad nauseum with the spot Bitcoin and spot Ether ETFs. We had these futures-based products before the spot came out. It just never made any sense to me. And ultimately, that was the crux of the Grayscale. That was the crux of the Grayscale lawsuit. At the end of the day, that the SEC approved futures-based ETFs, but they didn't approve spot. I don't know. I mean, there's a couple things maybe I can offer here. First, by the way, CME traded XRP futures actually went live last week as well. I don't know if you saw that. That was on Monday. We now have an XRP futures market on CME. The other thing that I liked, did you see the name of XRPI? It's just called the XRP ETF. I just kind of like that. I don't know why.
It's very direct. Very direct.
It's very direct. So that is the first one times XRP ETF. And then, as you mentioned, they launched a 2 times leverage version.
Yeah.
And I'm sure you recall, we had talked back, what was that, March or April? Teucrium had already launched the 2 times leverage XRP ETF. So this one from Volatility Shares, it's the second one. But if you look at that Teucrium ETF, it already has something like 120 million in assets in it, which I think is pretty good in that short time frame. And the other thing that I'll note is Volatility Shares, they launched similar ETFs for Solana, which that was kind of quiet. I don't even know if we talked about it, but they launched those at the end of March.
Solana had its moment in the sun briefly, at least in terms of chatter around it, and then it very quickly faded, and we all moved on to XRP instead. We're gonna have to go back to Solana though, because Solana.
Yeah, I mean that stuff ebbs and flows, I think, in the short term. But if you look at those two Volatility Shares ETF, one has 20 mil in assets, the other has like 40 mil. So not nothing, but. Here's all I'm going to say on this. And you already were heading down this path. We have these futures-based XRP and Solana ETFs out there. So naturally, everybody's asking, when are we going to get the spot versions? And the SEC, they actually delayed decisions on several spot XRP, ETFs last week. I don't read too much into any of that. And the reason why is that the new SEC chairman, Paul Atkins, he hasn't been in there that long. And I think he's still getting the lay of the land. And there's really no rush here. The SEC has time before all these spot ETF filings reach their deadlines. And so I just think he probably believes there's no reason to push the envelope here. But just for the record, I still expect all these spot ETFs to be approved before the end of the year. I really do.
It kind of happens.
I would agree. Yeah, I would agree with that.
You can't go out and approve leveraged ETFs on XRP and then not and keep,
again, they've done it before, but I think this SEC is different. So yes, the old SEC, they actually did that, and they let these futures-based products trade for, several years before they allowed spot to come to market. I don't think that's going to be the case here.
Yeah, that's not going to happen here. It just does again beg the question, which is like, why? That doesn't make sense to me personally. Like, if you can buy the leveraged version, I mean, in my mind, it surely can't be for the benefit of the investor and for the.
Yeah, but that's where we start getting into the weeds on stuff like market surveillance. So one of the ways that the spot Bitcoin ETFs and Ether ETFs were approved, or one of the reasons, is because you had the CME traded futures market that had an established history that the SEC could look at as a venue to surveil in case there was market manipulation occurring. And you don't have those fully established. You don't have that sort of track record for XRP and Solana. Now, nobody says you have to have a futures market in order for the ETFs to be approved, but the SEC does have to be comfortable around how to surveil the underlying market. And so I think that's a piece to this. But again, I think, Kristin, they're going to get comfortable with the spot products. I don't think we'll be talking about this much more in the future. We'll be talking about what the demand for these products will be.
That's my other next big question, which is there actual investor need and interest for some of these products that we're seeing, particularly in the crypto space? We've kind of touched on that before, the sort of parade of crypto ETFs that are and meme coin ETFs that are kind of slated for approval, or rather at least slated to be considered by the SEC. And really, how much does an investor really need some of these products? We're going to see. And then I'm honestly just looking forward to see the ETF that holds a bunch of them. The ETF that holds XRP and Bitcoin and Ether.
Yeah, and I think those will do well. The other wild card, which you and I have talked about, and we don't need to rehash this, but let's say Schwab, for instance, offers direct spot crypto trading to where you can own Bitcoin and Ether and say XRP right alongside your VOOs and your other ETFs. Well, if that's the case, technically you don't need these spot ETFs at all.
Oh, I know.
Right. So I'm just saying that's going to be another factor in terms of how that impacts demand. I mean, I always said these spot ETFs were a bridge between, TradFi and DeFi. But, a bridge, you don't stand on a bridge. You ultimately cross the bridge. And so we could get to a point where...
What a moment of profundity for us.
I've got more where that came from.
What a way to end the show. You can't stand on a bridge. You have to cross it from one side to the other. I'm going to bust out.
Nobody ever thought of that.
I'm going to bust one out next week.
All right.
Dealing with ships and being safe in harbor. I'll use that one next week. Well, that's it for this week's episode of ETF Pulse. What will we talk about next week? What crypto topic will we have for crypto chat of the week next week? You're just going to have to tune in and find out. Thank you so much, Nate, as always.